Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Twitter stock, their earnings that they just reported. So let's get started. Today is February 6, 2020, and Twitter just reported earnings this morning. They are up 17.68% at the moment right now, sitting at $39.27. So today we're going to take a look at how the company's doing. We're going to take a look at the shareholder letter that they sent out and any news article that we have available to us right now from Seeking Alpha. If you guys have not, I definitely do videos like this all the time, so make sure to subscribe if you guys want more content like this, and definitely post on the comments to let me know what you guys, what videos or what companies you guys want me to take a look at. Finally, it does seem that many people don't know I do have these videos in a podcast form. So if you guys want to look for podcasts, just check my name, Jose Najarro, buy or pass in the podcast, and you will find me. All right, so like I mentioned, right, Twitter is up 17.6% right now, and that's a huge jump. It's supposed to be one of its biggest jump since early 2017. First, we're going to see how the earnings per share and revenue beat compared to what was expected. Twitter earnings per share missed by 2 cents. Their non-GAAP earnings per share were 25 cents, which missed by 2 cents, and their GAAP earnings per share was 15 cents, which also missed by 2 cents. Revenue was 1.01 billion, and that's an 11% year-to-year increase. And that's pretty crazy, right? Like I keep talking, all these big companies, right? I do consider Twitter a decent-sized market cap company. They're still having these double-digit growth, and we see 11% growth year-to-year, and it did beat by 15 million. 15 million to that 1.01 billion. It's a very small number, but it's still a beat. So average monetized daily active users were supposed to be expected about 148 million. They actually had 152 million. So we see an increase there, and we see an increase in all their revenues. In ad revenue, they're up 12%. In data licensing, they're up 5%. In US revenue, they're up 17%. In international revenue, they're up 3%. So all these are definitely a strong reason for this company to be up today. All right, next I want to take a look at is this company's forward PE ratio for next year of December 2020. This company is estimated to make somewhere around 92 cents per share, and that gives this company a 36.31 forward PE ratio, and that's pretty high compared to the current PE ratio. But one thing that we're going to see in this episode is Twitter wants to grow their overall infrastructure. They want to invest a lot into the company, increase employee numbers, increase their servers. So they are going to be spending a lot more money this upcoming year, and that's why we see a lower earnings per share. But that's why we're going to see a higher forward PE ratio. But looking forward, that those investments are definitely going to help in the long run. One important thing to see is the revenue for next year is expected to be much higher than this year, over a 10% growth compared to this year, giving the forward price to sales ratio about 6.5 for December 2020, which is much lower than the one for December 2019. All right, so here we are taking a look at the results for fourth quarter of 2019 and for the full year of 2019. This is something they send out to their shareholders and for anybody wanting to look at the earnings. You can find this in their investors relations website. I took the liberty of highlighting all the ones that I thought were important. So those are the ones I'm going to go over. So like I mentioned, right, this is going to be for the fourth quarter and the full year of 2019. So right now, let's take a look at the full year of 2019. So for the full year of 2019, this company made $3.46 billion in revenue, and that was an increase of 14% year to year. And I just want to take a look at what was expected for this company. For this company, it was expected to make somewhere between 3.45 billion. So it did beat by 0.01 billion compared to what was expected for it. So that's a good. So we see that 14% year-to-year growth. 2019 cost and expenses total $3.09 billion. That's a lot of cost and expense in my opinion, right? Out of that 3.46 billion, they used 3.09 for cost and expenses, giving this about an 11% operating margin, giving this company only $366 million of operating income. For 2019, this company had a net income of $1.47 billion, representing a net margins of 42%. Compared to 2018, when they had a net income of $1.21 billion. But right, this you guys are gonna say, hey, how did this company do so good in net income if this company has such a low operating income, which usually has even less expenses than net income? And this is pretty crazy. This company had a lot of tax um income tax income, so they collected a lot of tax assets because they were doing something with their intangible assets of transfer. And for 2019, they collected about 1.21 billion dollars of tax assets. So that 1.47 billion dollars of net income, if we take away that tax asset, it really gives a net income of 259 million. And this is pretty cool that they are telling us this. Sometimes some companies don't include that and they just say, hey, yeah, we made 1.47 billion dollars on net income. But in reality, the true net income was 259 million dollars. And the true diluted earnings per share were 33 cents. In 2018, they made about 800. They had a huge in 2018, right? I mentioned they had 1.21 billion dollars of net income. But again, they actually had another tax asset that day where they actually collected $845 million just on tax assets. So their true net income last year was $360 million. So in reality, even though if we take a look at the full numbers, 2019's net income is definitely better than 2018. But when we take off those tax benefits, the net income of 2018 is actually much better than the net income of 2019, right? So let's just take a quick look. 2018, not including their tax benefits, was 360 million. 2019, not including their tax benefits, was 260, so about $100 million less. Next, let's take a look at this company's fourth quarter for 2019. Quarter four revenue was $1.01 billion, and I think this was the first quarter this company ever hit over $1 billion in revenue. This is an increase of 11% compared to the same time a year ago. Advertisement revenue totaled $885 million, which increased by 12% over a year ago. Ad engagement increased 29%, so more people are engaging to their ads. That's pretty good. That tells people that want to advertise into Twitter that, hey, they are good engagements out of this ads, so I am definitely gonna advertise on Twitter. And the cost per engagement decreased 13% year over year, which is good. Again, more reason for people to come in and buy. So I used to advertise a bit on Twitter. I don't do anymore, but because I did think it was a pretty expensive. But now I'm definitely going to try to take a look at them and see if maybe I can advertise this YouTube channel a bit there. Data licensing of the revenue was 123 million and increased 5% year over year. U.S. revenue totaled 591 million, increased 17%, and international revenue was 416 million, which increased 3% year to year. But we can see, right, this company really just has two forms of revenue: advertisement revenue and data licensing revenue. And advertising revenue makes up about 80 to 85% of this company's total revenue. The next comes from data licensing. So next, quarter four net income for this year was $119 million, which was a diluted earnings per share of 15 cents. Last year, they had some tax benefits. So if we ignore their tax benefit, this company last year gave $135 million in quarter four, which was about $16 million more. Not that big of a change of net income. Next, we're going to take a look at the average monetized daily active users. There were 152 million for quarter four compared to 126 million same time last year. So we see a nice growth, 26 million new users since same time last year. And same time and last quarter alone, it was 145 million. So just in one quarter, they added about 7 million users. Average million users increased in United States were 31 million compared to 27 million same time last year, and compared to 30 million last quarter. So they are seeing growth in the United States in both year to year and quarter to quarter. So quarter three of this year had 30 million, and now they had 31. International users also see the same thing. International users ended with 121 million, where same time last year was 99 million. So huge number increase there. And last quarter was 151 million. So they grew 7 million users in just one quarter. Now let's take a look at this company's outlook. they, like I mentioned, right, we saw that earnings per share were going to be a lot less this year compared to the same time last year. Estimated, right? One of the reasons were this year this company had a lot of tax benefits that we saw that helped this company's net income grow a lot. But the next reason is this company is expected to just increase the investments into themselves, which means they're going to waste more money, not waste more money, they're going to use more money. They expect to grow headcount by 20%, especially in engineering, product design, and research. They expect the total costs and expenses to grow up approximately 20%, which makes sense, right? If they're increasing their headcount by 20%, they're overall going to increase everything else by 20%. They're also investments also include building a new data center in 2020 to add capacity to support audience and revenue growth. So hey, they're saying we are increasing so fast, we're increasing at a nice pace that we need to have a new data center to be able to continue to support this amount of audience. For quarter one, they expect to have total revenue of 825 to 885 million, and they estimate to have operating income between 0 million to $30 million. So let me just take a look at what total revenue was same time last year. So same time last year, this company had $787 million of revenue compared to what they estimate of 825. So that's definitely a good growth. In the lower levels, that's probably about over a 775, 10%, 77. In the midpoint, we're getting about somewhere about 10% year-to-year growth if they get in the midpoint of this. So that's pretty impressive, and I like seeing companies have these double-digit growth in revenue. Next, we're going to take a look at this company's total revenue. Here, we're taking a look at the full year and just quarter four from 2019 to 2018. Total revenue in 2018 was $3.45 billion, almost 3.46, compared to 3.05 billion. So an increase by about 400 million in just a year. And we can see in this quarter, it increased by about 100 million in just this quarter compared to the same time last quarter. We talked about revenue enough, so now I really wanted to see what cost of revenue was coming at. The most important thing is I want to see how they're spending their money. So next, we're going to take a look at research and development. Research and development for the full year of 2018 was $553 million. For 2019 was $682 million. So an increase of about $130 million. And that's something I definitely like to see. I want companies to continue to research to increase themselves. So when I see growth in there, it tells me, hey, this company is really focused on improving themselves. Next, in sales and marketing, we see the same quarter-to-quarter growth, but year-to-year growth gives us a better look of things. For 2018, this company spent $771 million on marketing and sales. For this year, they spent $913, about 150 million increase in that. And again, I think that's pretty impressive. So now I just want to show you guys this net income. So net income for the full year of 2019 was $1.46 billion. So $1.46 billion compared to $1.2 billion last year. But unfortunately, right, a huge reason that net income was so high is because for this full year of 2019, this company had a tax benefit of a little bit over $1 billion. So in reality, this company's net income is somewhere around $390 million. So now let's take a look at the full year of 2018. Like I mentioned, their total net income was $1.2 billion, but again, they had a tax benefit of about close to $800 million. So that would give this company a similar $400 million of net income. And this company, it does seem that they do have a nice amount of tax benefit. And I'm guessing we're not going to see this a lot next year, this upcoming year of 2020, because they are estimating already such a low earnings per share. There's nothing else here I want to talk about in the net income. The only other thing is most of the time with companies like this, you see diluted shares go down, but the opposite is happening here. Last year, this company had 776 million shares. Right now, it's sitting at 788. So an increase of about 12 million shares that they diluted to either being to increase some form of expense or debt or some form of stock salary or stock compensation to their employees. But I'm not a fan of usually seeing that increase in diluted shares. All right, so next we're going to take a look at their cash flow statement. Their cash flow statement includes a lot of the benefits from their tax assets, tax benefits. So that's why we see a pretty big number compared to the actual true net income, which we discussed last year. But overall, it does seem to be downtrending in cash flow from operations, both in quarterly and yearly. But again, remember, this company is slowing down in that tax benefits that it's collecting. It does seem that on 2018, this company preceded some issuance of convertible notes, and that would increase the diluted shares. And this quarter alone, they opened up $700 million of senior notes. So that's another reason we see that dilution share. This company has taken out a few debt this quarter by taking out $700 million in senior notes, and last year they also took out a nice amount of about $1.1 billion of convertible notes. So this company is increasing their total debt over time, but they are repaying. For this full year, this company paid back $935 million of repayment of convertible notes. So we'll take a look at their 10K report when they post it, and we can see if that $935 million that they repaid this year had anything to do with the $1.1 billion that they sold last year. So maybe that went to that, or if it went to some other note that this company had. And the final thing we're going to take a look at is this company's balance sheet, which, like, if you guys know, this is my favorite thing to take a look at. Here you can really see how the company is doing. First, cash and cash equivalents. Right now it's sitting at about $1.8 billion of cash and cash equivalents, compared to $1.9 billion same time last year, at the end of last year. So we see a $100 million decrease in cash and cash equivalents. But that's not a bad thing, because short-term investments have increased by about $500 million. Last year, this company had $4.3 billion in short-term investments. This year has $4.8 billion, so about a $500 million increase in short-term investments. So we only see a $100 million decrease in cash, but a $500 million increase in short-term investments, which provide better gains compared to just cash and cash equivalents. Total current assets did increase by about $500 million. A big chunk of that coming from that short-term investments. The rest coming from accounts receivable, which is understandable. If this company provided more revenue, you would expect more accounts receivable and other expenses. Next thing I wanted to take a look at is I highlighted this operating lease right of use assets. This year, this companies have had. There's a new accounting rule that they need to provide something new in their assets and balance sheet, which is just long-term leases. So here they're saying that they have about $700 million new assets compared to the same time last year, where they did not have to report it. So if we take a look at total assets, I want to subtract this $700 million. So this gives company a total assets of $12 billion compared to $10 billion last year. So increase of $2 billion in total assets. 500 million of that comes from total current assets. So that's the first thing. The other major one comes from deferred tax assets. So for this quarter, this company, at the end of this quarter, this company still has a nice amount of tax benefits coming its way, which I guess we're definitely going to see better earnings per share for the upcoming quarters because they're going to have this tax benefit. But at the end of the day, right, I'm really liking this. Total current assets have gone up, and total assets have gone up mainly because of that deferred tax benefits. But hey, it's still money coming their way, which is always a great thing. The only thing is we got to keep in mind that not to really correlate it to the earnings per share, we have to deduct this to future earnings per share to give us the real number of how this company is doing. Next, let's take a look at the company's liability. This is, first we're going to take a convertible notes short term. This company last year had a liability of almost $900 million of short-term debt to pay it off. It paid that off. We have nothing this year. Next, this company had, again, this operating lease liability is something new. It's something that was not here back then. Right now, this company had 155 million in short-term lease liabilities, where it did not have any last year. So at the end of the day, total current liabilities decreased, which I think is such a good thing to see, decreased by about $700 million. We can see a huge reason for that was they paid off that short-term debt, and another reason is so it would have been a lot higher, a lot lower, but they had to now report that new operating lease of 150 million. So in reality, they did decrease their total current liabilities by a huge number. Next, let's take a look at convertible notes. So this is just long-term notes. This company increases convertible notes by about $100 million this year, and it also increased its senior notes, long notes, by $700 million. So about $800 million come from long-term liabilities. Then they have that long-term liability of operating lease, which I mentioned, which was not provided last year, which is about $600 million of long-term liability. So if we subtract that over the total liabilities, this company's total liability is pretty similar levels. It would be 3.4 billion compared to the 3.35 billion last year. So we can see a stable level in total liabilities. One of the main reasons is they took out huge amounts of convertible notes, long-term notes, and senior notes, which they say are going to help be paid off to pay off this new the new facility that they're building, and to help increase this growth that the company is trying to make. But so total liabilities are pretty flat, but we saw this company's total asset actually increase by a nice number, especially its current term assets, which I think are very important. So that's it. That's all I got for you guys. Let me know what you guys think of Twitter. Just a quick recap, right? Let's take a look. This company did provide very strong earnings per share, but one thing we noticed is this company has a strong tax benefit that has helped them increase that earnings per share. The actual numbers aren't that strong, in my opinion, compared to what they're really gaining from just tax benefits. We do see that tax benefits is actually going to help out for the next year, as they do have a nice amount of tax assets still, close to over $1 billion that we're going to see coming back to this company. Next, we see this company has definitely a strong balance sheet, right? We're seeing a growth in their asset sheet, and we're seeing a flat line on total liabilities. We're seeing growth in revenue for this company in all sectors and in all markets. We're also seeing a growth in membership, which again is also very important. Finally, this company is expecting to grow their facilities and their headcount, which will add more cost, and that's the main reason why we're taking out some of these loans. Overall, the company is doing pretty good. The only thing that worries me is what else does Twitter have besides the social platform? So that can be very scary. What other moat does it have? Does it have anything else besides social platform that I'm not 100% aware of? If you guys know, definitely feel free to let me know in the comments. But I'll probably do some more research on the company later on. So take care, guys. Have a good night, and see you next time.